So we start with Unit 1, which is on the accounting for banking companies. We are going to see how financial statements, mainly the profit and loss account and the balance sheet, are prepared specifically in case of banking companies. All companies, all organizations, they prepare these final statements or final accounts, but every single type of company, they have a different format, a different special pro forma that they are supposed to follow. Especially banking companies and insurance companies, they are regulated by a different authority. In case of all other companies, they are regulated by the MCA, the Ministry of Corporate Affairs makes the rules for them. Whereas in case of banking companies, they have yet another authority called the RBI. In case of insurance companies, again they have a regulator known as the IRDA, alright, the Insurance Regulatory Development Authority. So banking companies have a certain strict format to follow. What are these banking companies in the first place? These are institutions, commercial banks that have been provided the license, the permission to accept deposits, and they also act as a safe custodian of the customer's funds. So one main function of theirs is to accept whatever you deposit with these banks. Alright. So the main functions that they do is receiving, collection, transferring, buying, lending, investing in other securities, exchanging, they deal with foreign exchange, servicing money and claims to money, and so on. Okay. So remember the main activities. Okay. Receiving deposits, giving loans, fine, and of course opening all types of accounts. That again comes under deposits itself. So two major activities which banks follow or they do is they receive money, they accept deposits from customers, both individual customers as well as industrial customers, alright, and they also advance loans. That is how they make their profit, that is how they run their business, alright. So these are the major activities, and any company which transacts the business of banking in India is known as a banking company. Alright, that would be the definition of a banking company. Alright, so we are going to prepare final accounts of these banks under these two pro formas. Alright, balance sheet and profit or loss. The balance sheet as per form A, profit or loss as per form B. Okay, and this is as per schedule 3. Let's take a look at the format of the profit and loss and balance sheet. Now if you see, there is something called the main particulars and there is schedule number. If you remember doing final accounts under the recent format, schedule 6, you may know that we prepare something called notes to the final accounts, isn't it? Notes to the profit and loss, notes to the balance sheet, and then whatever details fall under any one item, we show all those details under something called a note, right? And then down somewhere we will write note 1, note 2, note 3, and so on. Same way, in case of banks, there are schedules. So there is a schedule number for every income, every type of expenditure, and you have to write it as per that number only. In manufacturing companies, the type of final accounts that we have studied, what happens is we are allowed the choice of giving our own numbers, right? For example, as we'll just see the vertical format of a random manufacturing company. So when you prepare, let's say P&L, okay, of any company XYZ, and you have, let's say, purchases, right? Or take for example, right here note 1, okay, and you might have say sales, fine, and you will give that note number 1, or you will say some other operating expenses or operating incomes, okay, and you will say note number 2. So you will give your own note numbers, or that order to the notes that you prepare for a profit and loss account. But in case of banks, it's not the same, right? You have to follow the schedule numbers which they have given only for that particular item. So if schedule 1 is let's say liabilities, alright, you have to write only liabilities under schedule 1. You cannot give it your own format or your own numbering. Okay, so let's look at a few things as to what is included in a banking company's final accounts. Fine. Now, banks, like I told you, have two functions. They accept deposits from people and they provide loans to people. Okay, so for the bank, when it accepts deposits, all right, now these are all customers, all they are the bank's clients. Okay, so when it accepts deposit, it has to pay interest, isn't it? Yes, interest paid or expended as we call it. And when it provides loans to people, it is the people or the clients who have to pay the interest to the bank, isn't it? So interest received. Fine. So it earns interest on the loans that it provides to the clients. It pays interest on the deposits that it accepts from the clients. Two simple things to remember. That is how banks make their profit. The difference between how much interest is paid and how much interest is received gives the profit or makes up for the profit of the bank. This is their main business. Take money, give money. Receive interest, pay interest. Okay, so accordingly, these things will be classified in our profit and loss account. So interest received will come in incomes, okay, and interest paid is going to come under expenses, right? So you have to remember that for banks it is the other way around. For example, if we are clients, okay, as individuals, when we take a loan, we pay interest, isn't it? And when we deposit something, we receive interest. Like for example, if you have a fixed deposit or you have a savings bank account where you deposited money, you will receive interest on the same. For banks, it is inverted. It is upside or the other way around, right? For loans, they receive interest, and for deposits, they pay interest. Okay, so with that we understand how these items appear over here. So interest earned on the loans is income, interest expended or paid on the deposits is expenditure. Then we have other operating expenses, provisions, and so on. So this is a very fixed standard format for the P&L. 1, 2, 3, 4 items: income, expenditure, P&L, appropriations. Now P&L is profit and loss of the current year, and whatever net profit or loss is brought forward from the previous year. That will be given in the problem. Now what are appropriations? The moment you make some profit here, alright, you have to decide what to do with those profits. How much to transfer to the reserves, how much dividend to give, how much tax to pay on the dividend, and then how much of that profit to carry forward to the balance sheet next year. Alright, that is what appropriation means. Appropriation, the word is nothing but utilization. How do you utilize or how do you bifurcate or divide the money between something? Okay, so once profits are made, they will be appropriated under all of these categories. So that's your P&L, and then we have the balance sheet in form A. If you see, the schedule numbers are the other way around. They start with the balance sheet 1, 2, 3, 4, and for the P&L they start with 13, right? Once all the schedules up to 12 are completed in the balance sheet. So again, what does the balance sheet look like? Very similar to other companies, except for a few differences. Like in case of assets, cash in hand, and also something called balance with RBI. You are aware that every bank has to maintain some money with RBI, isn't it? For the purpose of cash reserves. Then there is balance with other banks. That is money that the bank has kept with some other bank. Okay? Or other things like money at call or short notice that have been provided to other banks or any other clients. Fine? Investments, advances, fixed assets, other assets, so on. So again, look at these two things here. Deposits and advances. So your deposits, what you give to the bank, are a liability for the bank. For you it is an asset, but for the bank, whatever you have deposited with them is a liability. Alright? Whereas, whatever loan the bank has given you, that loan is an asset for the bank. Always remember, when we give loan, it is an asset for us because we have given to someone else and we will be earning interest on that loan, isn't it? So that's an asset. Whereas when we take a loan or take deposits from others, that becomes a liability because it is somebody else's money that you have to return at some point of time. So these two are very important items that you will have in your banking financial accounts, right? So this is the pro forma, and all of our problems will be based on either one of these. We will be preparing profit and loss account problems. We will also be solving balance sheet related problems.